Something shifted in the tax code for retirement, and almost nobody noticed. It changes everything about how much you actually keep in 2026. The IRS didn't announce it with fanfare or celebration. It's buried in recent legislation, but the numbers are real, and they're sitting in front of you right now. Here's what matters if you're approaching or already in retirement. There are new deductions, new cliffs, and new timing windows that can either protect thousands of dollars or cost you thousands of dollars. This isn't about being rich or having complex finances. This is about understanding how the system actually works, so you don't accidentally leave money on the table because you didn't know the rule existed. Most people find out too late, usually around April 15th when a tax bill arrives, and they realize they could have planned differently. In the next few minutes, I'm going to show you exactly how these new rules work, the hidden math behind them, and the straightforward steps to use them before they shift again. But the last part, the one nobody talks about, changes how you should think about retirement timing completely. Pay close attention here, because this compounds over time. The system was designed to work silently, and most people don't realize they're operating inside it. You work, you pay taxes, you retire, and somewhere along the way you leave optimization on the table, simply because the rule wasn't explained to you the way it should have been. The people who benefit most are never the ones waiting around to hear about changes. They're the ones actively looking. Now here's the twist. In 2026, the tax code adds something new, a senior bonus deduction worth $6,000 if you're 65 or older by the end of that year. It sounds small until you see the math for a married couple where both people are 65 or older. You're looking at a standard deduction plus age deductions plus this new bonus amount stacking together. That's roughly $46,700 in deductions just from existing rules, before you've even earned a single qualified dollar, before you've made a move. The money is already there, waiting to be claimed. But here's where most people miss the actual strategy. This deduction isn't free money. It phases out. And the phase-out math is where people accidentally give money back to the government without realizing it. For a single filer, the bonus deduction begins to phase out at $175,000 in income. For married couples filing jointly, the threshold sits at $250,000. Sounds high until you factor in business income, property gains, investment distributions, and Social Security combined. The phase-out itself works like this: for every dollar you earn above the threshold, you lose 6 cents of the deduction. It's not a cliff, it's a glide path downward. But the slope matters. If you're a self-employed person or a business owner, or if you're in your first year of distributions from retirement accounts, you can easily top $250,000 without thinking you're in complicated territory. And once you cross that threshold, the math accelerates against you. Most people miss this because they focus on the wrong number. They see $250,000 and think, I'm under that, so I'm fine. But they don't calculate backwards. They don't ask what happens if I pull one more distribution, or close a deal, or realize capital gains. What does that cost me in this deduction? That's paperwork fatigue talking. Nobody wants to run 3 scenarios before November. But the people who do run those scenarios usually save money, significantly. The second major shift in 2026 affects Social Security taxation directly, and this is where the bonus deduction actually becomes a strategy tool instead of just a number on a form. Here's the mechanism. When your income crosses certain thresholds, part of your Social Security benefit becomes taxable. The calculation uses what's called combined income. It's your adjusted gross income plus non-taxable interest plus half your Social Security benefit. The IRS then takes that number and compares it to a threshold. For a single filer, that threshold is $25,000. For married couples, it's $32,000. If your combined income stays below that, 0% of your Social Security is taxable. This is the part people overlook. The senior bonus deduction actually functions as a shield here. Because the deduction reduces your adjusted gross income, it can keep your combined income calculation below the threshold where Social Security becomes taxable. This is why the timing of when you take distributions, when you recognize income, and when you claim the deduction matters so much. You're not just reducing taxable income on a form, you're preventing the entire taxation of a benefit you've already paid for. Let me show you an example. Imagine a married couple, both 65. They have $120,000 in combined pension and Social Security income for the year. They own a rental property that produced $40,000 in profit. Without planning, their combined income sits at $160,000, and suddenly a large portion of their Social Security becomes taxable. With the senior bonus and other age-related deductions stacked, they can reduce their taxable income enough that their Social Security taxation triggers only partially, or not at all. Results vary based on your specific situation. But the window is real. Now here's where it gets expensive, if you miss it. The third piece that shifted involves state and local tax deductions. Since 2018, people who itemize have been capped at a $10,000 annual deduction for state and local taxes combined. Property tax, income tax, sales tax, everything. That cap was meant to be temporary. In 2026, that cap expands to $40,400, almost a fourfold increase for people in high-tax states: California, New York, New Jersey, Illinois, Massachusetts. This matters enormously. A couple in California with a $12 million home, paying $15,000 a year in property tax alone, plus state income tax on distributions, could suddenly deduct $40,400 of state and local taxes instead of $10,000. That's an extra $30,400 in deductions. At a 22% federal rate, that's roughly $30. 400 dex 022 = $6,688 in potential tax reduction. Sounds substantial, but there's a reduction built in that many people don't catch. If your income exceeds $55,000, the SALT relief reduction kicks in. The IRS reduces your allowable SALT deduction by 30% for every dollar of income over $55,000. This sounds bizarre until you realize it's a mechanism to phase out the benefit for higher income earners. For a couple at $200,000 in income, that phase-out eliminates a meaningful portion of that $40,400 benefit. Additionally, the deduction itself is set to expire after 2026. This is the part that creates timing urgency. The rule is alive for 1 year. After 2026, the cap returns to $10,000. Unless Congress extends it. That's not a maybe. That's structural. Most people plan as if these rules are permanent. They're not, and that changes how you should think about major financial moves. This is where it gets real. If you're considering selling a property, recognizing a gain, or making a large charitable contribution, the window for SALT deduction relief is closing. That doesn't mean you have to act in 2026. It means you need to model the difference between recognizing income in 2025 versus 2026, or between 2026 and 2027. The difference can be thousands of dollars. For a small business owner, this timing affects whether you accelerate distributions, whether you defer income, whether you trigger a large capital gain, or whether you buy equipment this year versus next. The SALT rule doesn't change the math on those decisions, but it does change the context. 1 year makes a difference. Now the fourth shift is quieter but more dangerous than the rest. This one involves Medicare premiums, and it operates on a lag that catches people off guard. Medicare premiums, specifically the income-related monthly adjustment amount, or IRMAA, are calculated based on your tax return from 2 years prior. If you're entering Medicare in 2026, the IRS is looking at your 2024 tax return. If you had a one-time event in 2024, a large distribution, a property sale, a business sale, inherited assets, your 2026 Medicare premiums could spike significantly. The spike itself is real and quantifiable. Medicare has specific income brackets. If your modified adjusted gross income sits at $100,000, your Part B premium is one amount. If it sits at $180,000, your Part B premium roughly doubles. That's not a slight increase. That's a structural jump in monthly costs that continues through the year, even if your income drops back down in 2025 and 2026. This is the part nobody notices until October, when the notices arrive. Here's the mechanism. You have a good year in 2024. You sell a property, you take a large distribution, your business has a spike, your income hits $200,000. You think, well, I won't do that again next year. Except Medicare has already locked in your premium, based on that $200,000 number from 2024. Your 2025 income is lower, your 2026 income is much lower, but your premiums stay elevated until Social Security reviews the impact of your newer tax returns. You can file a form, the SSA-44, request for reconsideration of earnings events, if you believe a one-time event caused the spike, but most people don't know this form exists, or they don't know how to use it, or they're simply resigned to paying the elevated premium. The relief is there, it's just not visible. Most people miss this because they don't plan 2 years backwards. Everyone looks forward. What will I earn this year? What will my income be next year? But Medicare doesn't work that way. Medicare says, what did you earn in 2024? Based on that, here's what you pay in 2026. This is where it shifts. If you're approaching early Medicare eligibility, or if you're in your early 60s thinking about when to retire, that 2-year lag is actually a planning tool. You can time distributions, You can manage income in 2024, specifically because you know what that number means for your 2026 premiums. Almost nobody does. They plan retirement as if it's a one-year event. It's not. It's a 3-year system where decisions in year 1 affect costs in year 3. So here's the practical question. How do you actually use all of this? It's not complicated, but it does require thinking backward and forward at the same time. Most people aren't trained to do that. Most financial advisors don't do that either, which is why this conversation matters. Step 1. Audit your income sources and projections for 2026 specifically. Don't just average the last 3 years. Actually model out what you're likely to receive: pensions, Social Security, investment distributions, business income, rental income, realized capital gains, everything. Write the number down. That's your baseline. Now check it against the thresholds we've covered. $175,000, single or $250,000, joint for the senior bonus phase out. $25,000 single or $32,000 joint for Social Security taxation. $55,000 for the SALT deduction reduction, and whatever your current Medicare income bracket is based on your 2024 tax return. Most people are shocked when they actually write these numbers down. They don't connect the dots between their various income sources until they see them all at once. That shock is important. It means you've found where your optimization lives. Step 2. Address the Medicare cliff specifically, because this one compounds. If you're looking at premium increases in 2026 based on 2024 income, you have 2 paths. First, you can reduce your 2024 reported income if you haven't filed yet, though this is only available if you actually made income errors or didn't claim deductions you're entitled to. Second, if you already filed 2024, you can use the SSA-44 form to request that Medicare recalculate based on significant life changes. This doesn't undo the lock-in, but it can prevent the lock-in from being permanent if your circumstances genuinely changed. Most retirees don't file the SSA-44. The relief just sits there unused. Step 3. Maximize your SALT deduction. If you're in a state where it matters, and if your income is under the phase-out range. This is a 1-year benefit, so it's worth calculating how much can I deduct in 2026 that I couldn't deduct before. If you have flexibility in timing when you recognize income or claim deductions, shift those activities into 2026 so your state and local tax deduction lands at its highest level. For someone in California who's considering a large charitable gift, for example, the math is simple. Should I give in 2026 when SALT relief is highest, or in 2027 when it's back to $10,000? The same logic applies to business income timing, investment distributions, and property sales. Step 4. Use income shifting strategies to stay under the thresholds that matter most to you. This is where individual circumstances diverge dramatically, which is why this step requires either serious attention or professional guidance. Income shifting means strategically timing when you recognize income and when you claim deductions so that your taxable income lands below the thresholds that trigger higher costs. The tools vary based on your situation. If you're still working and you can defer income, defer it. If you have access to charitable giving, a donor-advised fund lets you claim a deduction in the year you fund it. While distributing to charities over multiple years, you reduce your taxable income in a peak year without reducing your giving flexibility. If you have taxable investment accounts, qualified charitable distributions from IRAs let you give directly from your IRA and bypass the income entirely. Results vary based on your specific situation. The key insight is this: you're not trying to avoid taxes forever. You're trying to manage the year-to-year distribution of your tax liability, so it lands in the years when it costs you the least. Sounds complex. It's actually just timing for a Roth conversion. The mechanics are simple, but the decision requires careful math. You take money from a traditional IRA. You pay tax on it in a year when you might have room below a threshold, and your converted money grows tax-free forever after that year. If you're age 62 and you're thinking about when to retire and start conversions, doing a few large conversions before you claim Social Security, when your income is artificially low, can save you tens of thousands in taxes over your lifetime. The math works because you're moving income recognition into a year where it costs less. Now here's where the system reveals itself. These rules aren't secrets. They're published. They're in the tax code. Qualified professionals know they exist, but the way they're communicated, buried in legislation, scattered across IRS publications, but claimed in jargon, means most people don't encounter them until it's too late to act. And by the time someone realizes what just happened to their tax bill, another year has passed, and the opportunity is gone. This is the part that changes everything. The people who benefit most from these shifts are the ones who plan backward from them. They start in October, they model different scenarios. They make decisions based on what the numbers actually look like in 2026, not what they hope or assume the year will bring. They don't wait until April to find out they could have saved money. They run the math in advance and they act. Most people find out too late. Because they operate on a calendar year basis, income arrives throughout the year, taxes are filed in April, and any thought about next year's optimization happens in December, when you're already spent and just trying to finish the year. The people who get ahead are the ones who shift their timeline. They start planning for 2026 and 2024. They start thinking about 2027 taxes right now, while 2026 is still flexible. While this isn't about being good with money, it's about understanding the system before the system sends you a bill you didn't see coming. Let's circle back to the Social Security example, because it connects everything together. You've worked for 40 years. You've paid into Social Security. You've built a pension. You've saved money. Now you're retiring, and you start taking income. The government takes that income and decides how much of your Social Security benefit gets taxed based on what you earn. It's not that you didn't understand Social Security. It's that the interaction between Social Security and all your other income wasn't explained clearly in one place. The senior bonus deduction is designed to help here because every dollar you reduce your taxable income through this deduction or through any other legitimate deduction, you're moving your combined income calculation down. You're potentially moving it below a threshold where taxation triggers. This is invisible until you run the math. Once you run the math, it becomes obvious. And once it becomes obvious, you can make it happen. But the 2026 window is only 12 months long. After December 31st, these particular rules shift again. The SALT cap, for instance, reverts and you're operating under a different structure. That's not a threat, that's a fact. And facts let you plan. The question is whether you plan now or whether you wait until April 15th next year and see what you owe. Here's what I recommend thinking about right now. Pull together your last 2 years of tax returns. Sit down with the actual numbers, find out what your household income actually was in 2024, and what it looks like for 2025, and what you're projecting for 2026. Write those numbers down. That's your baseline. Now compare your actual numbers to the thresholds mentioned here. Not to be scared, not to be overwhelmed, just to see where you sit and what room you have. If you're significantly under the phase-outs and thresholds, the optimization is simpler. If you're close to them, the timing decisions become more important. If you're over them, you have different options entirely. If anything here resonates, if you're approaching Medicare age, or you're self-employed and have flexible income timing, or you live in a high-tax state, or you have significant non-earned income, spend a conversation with a qualified tax professional who understands these 2026 rules, specifically not a generic tax prep place, someone who actually thinks about strategic timing. The difference that conversation creates usually pays for itself many times over. The real takeaway is this. The system operates on invisible rules. Most people operate without knowing those rules exist. The people who know the rules, who understand the mechanisms, who plan with the numbers instead of just hoping things work out, they end up with more of their money. That's not luck, that's literacy. These new 2026 rules are your opportunity to become literate about how the system actually works. They're not complicated once they're explained. They're not optional. They happen whether you understand them or not. But understanding them first gives you the power to act. And that's the difference between filing taxes and strategizing through taxes, between hoping you'll be okay and knowing you're positioned well. The timing of this moment is important too. We're standing in late 2025 or early 2026, the final window where 2026 decisions are still flexible. The people making moves now are the ones who'll look back in 2027 and feel good about their choices. The ones who wait, they'll be filing taxes in April and wishing they'd acted sooner. There's no emergency here, but there is a window, and windows close. The opportunity here is real, and it's time-bound. The rules are clear, the numbers are available. The difference between understanding them now versus finding out about them later is usually measured in thousands of dollars. That's not dramatic, it's just math. And math doesn't care whether you pay attention or not. It's going to happen either way. The only question is whether you benefit from it or whether you just accept what the system sends your way. Choose the first path. Understand the rules. Run the numbers. Make your move. That's where peace lives in retirement. In the knowledge that you've done the work and you're positioned well. Senior bonus deductions shield retirement income through intelligent timing decisions. Medicare premiums lock in 2 years prior to coverage. Plan backward according. SALT relief and income shifting create measurable savings only in 2026. Take your actual numbers from your last 2 tax returns and compare them to the thresholds mentioned here. That single 30-minute conversation with your numbers changes everything.